Hi everyone. In this installment of Take Charge Now, I thought I would look at some of the differences between a variable rate mortgage or a fixed rate mortgage and which makes more sense to you. So here's my spoiler alert. It depends. It really does depend on who you are, your tolerance for risk. What happens if the Bank of Canada moves higher on rates, or do you think they'll come back down on rates? What sort of financial flexibility do you have? I can tell you, in the interest of disclosure, we have 4 adult children, all have mortgages. 2 are in variable, 2 are in fixed, all 4 very happy with where they're at and the decisions that they're making. Throughout our life, when we did have a mortgage, we were always in a fixed rate mortgage. I wanted the security of knowing what that payment would be. I didn't care where interest rates went until that mortgage was up for renewal, and I always felt I can deal with it then. Having said that, I was challenged. I once sat down with Moshe Milevsky. He's a finance professor at York University, and he challenged my assumptions, rightfully so. In data that he has shared widely, he has found that from 1950 to 2000, 88% of the time, you would have been better off in a variable rate mortgage, meaning money in your pocket, versus a fixed rate mortgage, so 12% only. The question is, that was then, this is now, is the interest rate environment changing that maybe a fixed rate mortgage is where you need to be? Well, what I can tell you is that the Bank of Canada, since March, early March, has moved on interest rates from 0.25% to 3.75%. That is a very rapid movement in a really short period of time. They are trying to beat down inflation and have more or less telegraphed that rates will continue to go higher until that actually happens. The next interest rate announcement is December 7th. Inflation is still stubbornly high. So will they move on interest rates? In all likelihood, yes. So let's assume that you're in a variable rate mortgage. Typically, your payments stay the same, but as rates continue to go higher, less is going towards your principal and more is going towards your interest costs. That just simply means that it's going to take you just that much longer to pay things off. If you're in a fixed rate mortgage, you don't care what the Bank of Canada is going to do on December 7th, unless of course you have a mortgage coming up for renewal. That's a different discussion. But when you think about where do we stand, variable rate mortgages have been on the rise. In fact, from 2020 to 2021, the average mortgage origination was $380,000. If you had been in a variable rate, and this is an approximate number, the cumulative interest rate movements means $745 per month more is going towards interest versus your principal amount. But here is the word that many people are talking about. What is your trigger amount? And we all need to know, if you're in a variable rate mortgage, what that is. And what I mean by that, how high do rates have to go that your mortgage payment is eaten up entirely by interest and then some? Because if it's higher than your amount of what you're paying monthly, your lender, your financial institution, will likely come back to you to say you've got to pay more. And if you don't have a lot of financial wiggle room, that's where it could prove to be very difficult. So often when I'm talking to people, do you go fixed rate mortgage or variable rate mortgage? Do you have a regular steady income that you know you can count on? Are you someone that has an emergency fund? If rates go higher, can you draw on that money because it's an emergency to put more money towards your mortgage, maybe even only for a short period of time? What kind of financial flexibility do you have in your life? And here's another one. When you really think about it, were you able to come up with a large down payment? So your mortgage may be at a point where you've been able to pay it down, or it's relatively small, and that too gives you some financial wiggle room. It all depends on who you are. But here's one thing I do know, and this protects us from ourselves, because when it comes to home ownership, it is typically our largest asset. It's an emotional asset. It's an expensive asset. And in order to qualify for that mortgage, whether you have 20% down or not, here's what you need to do. 5.25% or the contract rate plus 2%, whichever is higher. As long as you qualify for that, you've got that financial wiggle room. And one last thought, it's not always just about the rate, whether it's variable or whether it's fixed. It also can mean knowing the bells and whistles. What if you want to convert from a variable to a fixed? What's the cost? What happens if you move? Are you allowed prepayments? Bottom line is no one wants to be house poor. We're in a period of uncertainty, but the one thing you can control is knowing your numbers and what makes sense for your household. It's not an either or. You're not right or you're wrong. It just depends on who you are, where you're at, and how high can you afford to let the Bank of Canada go on interest rate moves.